rather flock into bonds that pay you nothing or that you even guarantee the loss than go into the stock market. Now, there can only be two reasons, and we know the reasons, Mike. One, investors are really scared right now. I'm not talking just the retail investors. I'm talking about smart money. And institutional money is as scared right now as they were in 2008.
SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. We are committed to being your trusted source for low-cost, highest quality investment-grade bullion products. Visit SDBullion.com for more information.
Welcome to Silver Doctors. I'm excited to have returning guest, Mr. Lior Gantz. He's the author and creator of the website wealthresearchgroup.com. And today he's joining us to share his thoughts on a variety of subject matter. So Lior Gantz, welcome back to Silver Doctors.
Thanks, Mike.
Well, I appreciate you taking time to sit down and join us. And so definitely want to find out what's your thoughts on a variety of subject matter. And so before we get started, at this current moment, what are some things that you're keeping an eye on or concerns you about the global markets?
I think the one thing that perplexes me the most is the fact that investors are so bullish on bonds. What we're seeing right now, Mike, it's something that we've seen only 3 times in the last 39 years, where if you take the dividend yield of the S&P 500 and you look and compare it to the dividend yield of lending money to Washington for 30 years. So from here to 2049, you make more money with the S&P 500 dividend yield. So just so everyone is on the same page, what is the purpose of diversifying between stocks and bonds? Stocks over the long term have outperformed bonds in a manner that is not even comparable. If you go back to 1812, where the data starts, every $1 in stocks is worth about $700,000 inflation adjusted today. With T-bonds or with just corporate bonds, you're looking at something like a few $1,000s. So obviously a great return, but not even anywhere close to stocks. So if you're 35 like me and you have the choice between stocks and bonds and you don't need your portfolio, you don't need to liquidate your portfolio in the next 2 to 3 to 4 to 5 years, but you can let it ride for 30. You can be a net buyer essentially for 30 years or 40 years, whatever, however you live and whenever you look to liquidate it, if ever, then stocks would always be your best choice overall. 75% of the time, the S&P 500 is up. If you look at it over time, it is an incredible wealth creator. But in the short term, if you have any short-term needs for your cash or you need some of that money that you have in stocks in the next year or 2 or 3, what investors do is liquidate stocks, put it in bonds or in other short-term assets because they can get a better yield than stocks most of the time, and because the risk is lower, right? The risk of something happened to a bond as compared to what can happen in the stock market short term is always going to be better in bonds. And so I just don't understand why $17 trillion in long-term debt, not short-term debt, rather flock into bonds that pay you nothing or that you even guarantee the loss than go into the stock market. Now, there can only be two reasons, and we know the reasons, Mike. One, investors are really scared right now. I'm not talking just the retail investors. I'm talking about smart money. And institutional money is as scared right now as they were in 2008. That is an important thing to understand, because people think, hey, after 10 years, stocks are very expensive. There's no euphoria. Stocks are not expensive compared to bonds at all, even after 10 years. Because if you look back a little further, Mike, It's true that from 2009, June of 2009 until today, so in the last 10.5 years, the stock market is up incredibly. But if you look at the past 17 years, since the bottom of the dot-com bubble, where the S&P 500 was 800 points and today it's 3,000, it has been a horrible investment overall and compared to historical precedents. So stocks are historically cheaper than perceived, and if you adjust them for the bond yields, they are a bargain. And so what I'm really concerned about is what is going to happen when rates are lowered across the board. So all central banks are going to ease, and all this debt is going to get refinanced at 0%. And if you only raise it from 0 to 1%, you're causing a situation where people's interest payments, not principal payments, but interest payments on their homes, corporations on their debts, governments on their obligations, etc., becomes unbearable. So a 1% economy becomes unbearable. That is a very bad situation, because if you can never raise interest rates again under this current structure, you have only two options. One, you have to really inflate the debt away. That's not happening because of a number of reasons, predominantly because of demographics and because people are scared. They're not borrowing like they've done in the baby boomer generation. And secondly, because of demographics of retirees. So all of this is creating a lot of deflationary power. And if you can't create inflation using fractional reserve banking, you can only do one thing, which is write-offs. So you can devalue currencies by writing off debts. And that is something that is very disruptive. Very disruptive. When you announce that kind of thing as a government, you can really disrupt markets. So if you ask me what am I concerned about, I'm not concerned about anything in the short term. I don't see any excesses anywhere. In fact, we are experiencing actually a dollar shortage in emerging markets and in Europe. What I am very concerned about is how in the next decades governments will start to unwind the debt that they have assumed in the decade that has just ended, right? The 2010 to 2019 decade. So that is the biggest concern. It's more of a long-term concern. If you ask me, about tomorrow or the next few months, etc., what I am interested in more is politics. How politics will play out in the next year. China will look to stall as much as they can until the elections on the trade deal, because if they don't have to deal with Trump, if there's another president, then that's what they probably would want. It's not just them. Iran is looking at what's happening with Trump. Europe is looking at what's so the U.S. elections is becoming like this thing that halts economic activity around the world, and that could potentially be the catalyst for a slowdown. I wouldn't say recession, but definitely a slowdown, because if everyone's waiting, that creates a lot of stagnation in the economy.
Okay. Well, let me go back for 1 second before we move on any further. I'm curious to get your thoughts on the bond aspect, because just recently Stephen Mnuchin referenced or hinted at the idea of possibly going out a 50-year, and then there's other countries that already have a 100-year bond. What would be the purpose, and how would that actually work if they came out with a 50-year bond?
Well, if there was ever a time to kick the can down the road, it's now. So that is why Trump is so adamant about lowering interest rates to zero. If you go to wealthresearchgroup.com/enemy/Fed and /Trump, these are 3 exclusive reports that I wrote about this situation, and Trump has been right. He has been right for a number of months. In September 2018, when gold was 1,200, and it dropped for like a couple of days to 1180. I bought my last batch of 50. I bought 50 ounces of gold eagles, and I said, "Look, this is the bottom. In my opinion, this is the bottom." And the reason I said that was because the Fed they raised rates too fast. Not that they raised it too high. It could have gone higher. The economy would have been fine with 3% and even 3.5%. might even been 4%, but they did it so fast. And while the rest of central banks did not do the same thing, that there was such a disparity between the U.S. dollar and the rest of the fiat monetary system that investors just flocked and took all dollars that they could find. There was a dollar shortage, and therefore in December, when Powell said, "Look, we're a long way from neutral," I knew this is it, because that's the ultimate contrarian catalyst. When the Federal Reserve chair tells you something like that, that reminds me of Ben Bernanke saying we have no real estate bubble in this country right 3 months before the bubble erupts. So when he said we were a long way from neutral, I knew, look, the markets are done. They're gonna crash on him, and he's gonna change tune. And that's exactly what happened in December. We saw a 20% drop, and then a pause, and now rate cuts. So if you're looking at this phenomenon in general, you can see that there's a situation where the U.S. dollar had to have weakened if the Fed had raised rates. So that's what you want. And if you have a central bank that raises rates, you want your currency to weaken at the same time so you can increase exports. Because if you raise rates, your interest payments are going up. So you want to compensate that with a weaker currency and with more exports. But if you have all of it at the same time, higher interest rates and a stronger dollar, you're losing out on exports and you're just paying more and more out. So that is why Trump wants it at zero. He wants it at zero and then marginalize the Fed. Fed out, and essentially Washington taking over policies. It's so monetary policy getting marginalized and fiscal policy getting the central stage. Because why? With monetary policy, with lowering interest rates, who won? Who benefited in the past 10 years? So the markets are up about fourfold, and real estate is back up to pre-crisis levels, and wages are up 3 or 4%. So they're keeping up with inflation. Obviously, monetary policy has helped the wealthier 20% of Americans that own assets, own bonds, foreign investors. It's helped a lot of foreign investors, but it didn't help the bulk of the lion's share of Americans who make up the country. And so fiscal policy can do that. It can include more people. How? You incentivize. You create what's called distress zones. It's already been done. You incentivize corporations to go into this distressed zip codes and retrain employees, educate them. You give them tax breaks, etc., to build real jobs. You can do an infrastructure program. You reform taxes. You can do all sorts of things that help a lot of more people. And that's what Trump wants. Rates at zero. Refinance the entire national debt at 0% interest. You save about $500 billion a year. And then get going on fiscal policies if he gets an additional 4 years in office. The only problem is you're asking yourself, well, what's the downside, right? We pay less in interest. We get all this stimulus. The downside to all of it is that if inflation picks up through organic lending, so millennials forming families because they haven't yet, buying homes, etc., more mortgages are initiated, and by and large, you get 3, 4, 5% real inflation, and that in 10 years lowers the dollar by about 30 to 40% in terms of real terms. So that is the problem, because you cannot stop that like they did in the late 70s with raising interest rates. If you get higher inflation in the U.S. through organic means in the next decade, you're in a problem. And so Trump is taking a big risk. On one hand, he's expediting the end game by asking the Fed to lower to zero. And on the flip side, if it works, you're lowering the debt burden for the next 50 years, and you're allowing the United States to basically restructure its economy to the 21st century, retrain the population. So it's definitely a huge risk, There are obviously things you can put in place, but if it goes wrong, you're going to see the dollar losing a lot. And if you are not hedged properly, you're not invested properly, etc., you're gonna suffer from massive inflation.
All right, so there's a couple of things you mentioned there that really stood out. So if they get the fiscal approach, the infrastructure spending, and other things that will be positioned as an option and go down to zero, what about those savers? People who save in bank accounts. I'm assuming we'll have problems with the banking sector. So isn't a zero environment, somewhat of a dangerous territory for those that are using practical matters as far as saving and investing?
Yeah, definitely. It's the biggest issue for them. So savers are the ones that will get hurt the most, and pension funds will get hurt the most because pension funds invest mostly in bonds. What you're going to see in the coming decade, between 2020 and 2029, at some point, the borrowers are going to either partially default, restructure their loans, or otherwise. And therefore, if you borrow money right now, and you have a good purpose for it, or you good use to it, you're doing the right move. For example, I'm taking on non-recourse loans in the real estate market. I'm paying like a 30 or 20% down payment on a house and getting the rest refinanced or financed with a non-recourse loan. So the renter is going to pay for all of my expenses in terms of like the principal and the interest, utilities, management. I'm going to get a free cash flow after that. And if there's any issue, it's a non-recourse loan. Those are the most beautiful. You can just walk away. If there's any issue, you don't go underwater. You don't need to deal with a short sale. There's no personal guarantee on your name or your credit, etc. And if I'm doing that, right, on the personal level, think about governments that are doing that on massive scale, institutions that are doing it on massive scale. That is what's happening right now. All of this debt is going to get refinanced at zero. And then if there's any problem and you need to hike interest rates, you are going to see the mother of all credit crunches. You're just going to see a massive default cycle. So if you are going to take on debt, make sure that you have a lot of liquidity to handle those risks. But if that works out for you, you're going to make a fortune. That's what's going to happen in the next decade. For a saver, I would say, look, if you have savings, don't put them in fiat currencies. There's really no reason. There's no justification for having more than 20% of your savings in fiat currencies and the rest just diversified in a right way between asset classes. If you don't want to deal with that, if you don't want to learn how to invest, then at least have some diversification in the minimal sense that you should have some precious metals, perhaps some private lending done on the side, like with Lending Club or Peer Street or any of those platforms. Do something to generate some activity with your savings, because just having money stored or currency, I should say, stored is not going to be a smart move at all. If you go to wealthresearchgroup.com/reset, you can see exactly how this sort of a decade will play out if things are not managed in the right way, and what can happen if Trump doesn't get reelected and a Democrat gets to sit in office. The first thing that investors are going to do is sell off stocks, because Trump has been very pro-business. Just the deregulations that he's done have added about $5 billion to the U.S. economy, and they've added many, many jobs. If you have, from the other hand, someone that say, look, I'm going to ban fracking, like ban the most lucrative oil industry that the U.S. has, or say something like, we're going to tax the wealthy, which gives them incentives to offshore and do all kinds of stuff. That is really going to hurt markets, and that can create a situation where interest rates are higher and all kinds of stuff. I'm not an American, and for me, if Trump wins or loses, it will have marginal impact on my life in terms of politics. but it will have a lot of effect on my life in terms of investing. The end result of the Trump policies have been that he's floated all sorts of problems to the surface, problems that in the Obama era Americans didn't want to face. So Obama, he was so good at uniting the country that people just didn't want to listen to that there are issues, that there are problems, etc. But in the Trump era, he's floating everything. And so what you're seeing right now is this is all your problems floating. And I think if you're able to start solving these issues and being a grown-up about it, which is what he's trying to create with the country, you can debate whether or not his vulgar, aggressive, violent ways are in terms of his speak, right, his Twitter and all that are good or not for the country. But the strategy itself of putting everything in front of you and telling you, hey, this is not the 1950s. We don't dominate the world anymore. We need to rethink America and how we do stuff. I think that has really helped Americans come to grip with what's happening. So I know I'm kind of talking like in two various ways. There's a good economy and a rotten balance sheets for the government, but that's the world we live in. We live in a world where the economy is doing good, but governments are basically doing very badly because they haven't made tough decisions yet. They haven't addressed unfunded liabilities yet. They haven't addressed a lot of the issues that were dragging for the past 40 or 50 years here. And so this is what's going to need to occur in the next few years. But I don't think that just any person is suited for this. I think it takes a very unique individual to do this. Here's the beauty, though, Mike. When you are on your second term and you don't think about whether or not what you're doing will impact if you get reelected or not, you can make tougher choices. And that's what I think is important. If Trump gets reelected, he's going to make some very tough choices and tough decisions if he gets reelected. That's a positive.
Well, I do agree, and so I'm curious to get your thoughts about just you hinted at precious metals a little bit earlier. Now, gold and silver. So if all this stuff plays out, the good, the bad, if it collides, so we have the monetary issues with the Federal Reserve, and so I want to get your thoughts on that. Will they be? You said they raise rates too fast. Now, will they be dropping rates too fast, or should they give it a little time in between? That's going to be my first question. And then the second question: if all that collides, then precious metals obviously will be a good way for people to preserve there's some of their wealth there. So give me your thoughts on the Federal Reserve dropping rates either too fast, too slow, or what would be the ideal policy for them to possibly consider?
So as long as they can drop it by 25 basis points, the classic minimal default, they will. But once they drop it by 50 basis points in one decision, they will continue to do so. Whether or not it will go to zero, it's hard to predict because it's not just a financial or economic decision. To get rates to zero again in the U.S. is a very political decision. So in an election year, I would assume that they won't. I would assume that they would tread lightly right now. Where precious metals are going, one thing I want to say about precious metals, since 1971, when Nixon basically took the world on this scam of fiat monetary policy, gold has gone from 35 to 1,500, and that's 45 times your money. Silver has done just about the same, a little less. So you've seen an incredible return with precious metals, better than the S&P 500 at the same time. S&P 500 went from 30 points in 1971 to 3,000. So 100 times, from 90 points in 1971 to 3,000 now. So about 35 times your money. Gold has actually beaten stocks in the past 48 years. That is unprecedented. If you go back to 2000, gold has beaten stocks this century. If you go back, unless you are one of those people that bought between $1,600 to $1,900 an ounce, no matter which point you bought in the last 5,000 years, you are up on gold. There really isn't any reason not to own gold. There really isn't. Now, if you bought it in 1980 at 850 an ounce, you had to wait a lot of time, 30 years to get your money back, but you did. And so gold, like anything else, if you overpay for it, and when I say overpay for it, I just mean that if you pay too much relative to where it is at compared to stocks and bonds or real estate, then you're making a mistake. In other words, there is a moment where buying insurance doesn't make sense if the insurance is too costly. And in 2011, it's a great example of that. 1980 is a great example of that. If an ounce of gold buys you so much productive assets, real estate and stocks, then you should buy real assets, real estate and stocks. But on the flip side, when it doesn't, you should buy that. The best way to look at it is what's called the Dow to gold ratio. And that is really the most important chart in finance. If you look at the Dow to gold ratio, you can always understand whether or not you should be buying gold or you should be buying productive assets in general, and times that you should be in between, diversifying. Right now, we are at a point where buying more gold than stocks makes sense, but it's not a time to just buy gold or just buy stocks. So that's where we're at right now. What will happen in the next decade with precious metals? They're going to keep going up in price. Whether or not it's going to be smooth, volatile, etc., who cares? They are going to go up in price.
Sounds good. Lior Gantz, it's been great having you join us here on Silver Doctors. For those that may not be familiar with your work, I'm going to also link your website down there. Any last thoughts you want to leave us with before we sign off for today?
If you want to stay updated with the top priority stuff, the highest quality information, just go to the newsletter, to the Wealth Research Group homepage. You can subscribe to the newsletter. It's a free newsletter, always been free, and it's always going to stay that way. So that's the best way to just stay updated between these interviews that we keep on doing on everything that's going on with my own portfolio, with what I'm doing with my own money, and then with the big picture as well.
Once again, thanks for joining us on Silver Doctors.
Thank you, Mike.